Good morning, everyone. Thank you all for joining today's ATRAM market update. I am Santi Elizalde, Business Development Officer at ATRAM. To update us on the latest news and insights surrounding the market, I have some familiar faces with me this morning. I'd like to introduce ATRAM's Chief Investment Officer, Mr. Philip Hagedorn, ATRAM's Head of Multi-Asset, Ms. Sandra Araullo, and ATRAM's Head of Equities, Mr. JulianTarrobago Jr. The format for this morning's webinar is going to be, first off, an introduction by our Chief Investment Officer. Then we'll hear an update on global markets, and then finally local markets. We will aim to leave 10 minutes at the end for Q&A. However, before we begin, I'd like to remind everyone that you may ask questions throughout the discussion by clicking on the Q&A button on your screen. If you would like to ask a question anonymously, you may do so by choosing that option in the Q&A section. We'll get to the questions at the end of the discussion. Additionally, I'd like to let you know that this webinar will be recorded and that copies will be disseminated within the day, as well as posted on all our social media pages. So let's kick things off with our Chief Investment Officer, Mr. Philip Hagedorn.
Thank you, Santi, and good morning to everybody. Just want to start with a short recap of markets and how they behaved over the last week. Obviously, I think the main message and the main message we're getting from the market today is stability, this week at least. So let me start just in the fixed income markets. We've seen, just as an example, a lot of volatility there. The government 10-year paper, which was yielding 4.8 last week, shot up to 5.5% before retracing that move and dropping back to 4.8% today. You know, that's volatility of about 5% there, up and down. And I think that kind of exemplifies how markets have been over the last week. This week, though, we're starting to see more stability. This is primarily driven because the Treasury is seeing more options, really. There are no rush to raise any money at any price. And I think that's a good sign. The BSP supported this by being proactive. They've cut the reserve requirement rate 200 basis points and the overnight rate by 50 basis points. And this is adding to the liquidity in the market. So for this week, we're seeing a lot more stability in the fixed income markets, although volume trading is still quite thin. On the equity markets, again, we're seeing a much better week. Actually, we've seen a recovery, a very strong recovery from the intraday low on the 19th of about 24% as of yesterday's close. The market is up around 5% right now from yesterday's close today. I don't think we're out of the woods yet. We've got a long way to go, but this is the first good step. To give some historical perspective, I think we've started to look at a lot of data from previous crises, specifically focusing on the Asian financial crisis, the global financial crisis, and even the '89 coup attempt, where we have some data. And these bounces are not unusual. I think in every one of these markets, once the panic settled down, sentiment had a little change and focus more on fundamentals came into play. And I think although the fundamentals are still unclear, there seems to be a general sentiment in the market this week that some bottom fishing is going on. I think that's likely to continue. The volatility is likely to remain. I don't see this being a V-shaped recovery just yet, but for now, we'll take the strength the equity markets have given us, and we continue to adjust portfolios. Later on, JulianTarrobago will share with you some of the strategies we're doing and are able to execute in this time of volatility. From the macro picture, I think there's more data coming out, more information regarding updates and where GDP might head. Last week, we had an initial run and downgraded GDP from 5.8 to around 4.2%. um, looking like a wide range of different forecasts from different sectors. No, the most aggressive being right around the 4% level, with some views of recession. The most interesting for me right now has been the view of Congressman Salceda, who says that we can eke out maybe 3% growth. And I think the key to this will be the ability of the government to really ramp up their spending. They are the largest employer of the country, and they have the finances and firepower to get started quickly once the medical emergency is under control. So I think we are revisiting these numbers, and hopefully by next week we'll be able to give you a new update with more color on our GDP forecast for 2020. So I'll leave it at that for now. I'll give the floor to Sandra, who's gonna kind of talk through the global markets and some views on local markets, and then June to get more specific for Philippine equity. So thank you very much again for joining us today, and look forward to your questions later on. Thank you.
Okay, thank you, Phil. Let me remind everyone to please continue asking your questions using the Q&A button on your screens. We'll get to them at the end of the discussion. Moving on to the next phase of our webinar this morning, I'd like to pass the mic over to Sandra Araullo. We'll take a closer look at the situation from a global perspective.
Good morning, everyone. Thanks for joining us once again. It's been quite a volatile few weeks for capital markets, as you all know. And I want to start my talk today focusing on that. So if you would go to the next slide, please. I prepared here a chart that basically captures the scale of the volatility that we've been seeing. So represented by US equity markets and US fixed income markets. So easily, if you go back to 2008 GFC, we're there in terms of volatility, in terms of how much swings we've seen in the markets on a day-to-day basis. And I guess one other thing we want to highlight is that the speed of the movement has also been quite impressive. So, you know, the question becomes, is this the same as 2008, the global financial crisis? Are we planning to position our portfolios in light of that kind of a situation? It's developing, and I guess I'll walk you through some of the things that we're taking into consideration in terms of answering that question. On the next slide, you're going to see how equity markets, or this here is the MSCI World Total Return Index. So it's just a benchmark for global stocks. And the yellow line is the 2020 drawdown that we saw in the past few days, in the last month actually. And the red line is showing you the movement, the downward movement in markets since 2008 Lehman bankruptcy. So, you know, again, it's just based on this, it's kind of tempting to jump to the conclusion that this is, you know, as bad as the global financial crisis. But I guess there's a very big difference between what's going on now and what happened back then. Back then, the crisis originated from the banking system. Today, it's really a shock, or a supply and a demand shock that is akin to a natural disaster. But as we'll see in the next few slides, there has been there has been appropriate or as much as what's possible action from policymakers, the central banks, and the governments on the fiscal side. And it's exactly what we need to see to be able to determine if we can avert such a fallout. Because what I want to point out is, unlike 2008 when the problem started in the banking system, today it didn't, but there's still a chance that it could really spread to that in the form of credit defaults, because companies can't operate in this kind of an environment. And so it's still a wait and see. It can still get bad, but the question is what's going on and what are the chances of that really happening, given what we're seeing governments are doing right now. So if you go on the next slide, these are, sorry, can you go back? The previous slide is showing how, unlike 2008 or unlike the global financial crisis, the banks are not yet a source of stress, like what I was pointing to earlier. And this doesn't mean that it can't go to the spreads that we've seen in 2012. There's 2008, and then you have between 2000 around 2012 the sovereign crisis in Europe. So things can still get pretty bad if this isn't handled, if the situation isn't handled well. So if you go to the next slide, you'll see here the response so far that we've seen. The solid lines just show how markets are a bit ahead in terms of pricing where central banks are expected to go, and at least in the last, around the February 2020 mark, clearly the Fed didn't disappoint. There was such a big move in U.S. Treasury markets, reflecting expectations that they must loosen policy to respond to what's happening. Unfortunately, for the other central banks, there isn't a lot of room to support on the monetary policy side. But the good news is, the monetary support at this point is really just to provide some liquidity for your small businesses, those self-employed. So it isn't really the instrument that will see us through this crisis. It's actually more of a lifeline that the central banks are giving to the economies. And similar to what our government is doing, as Phil mentioned earlier, the BSP also has kind of announced bond buybacks, and that's really to make sure that there is that liquidity and we can function not in a less disrupted way. If you go to the next slide, you're going to see here the fiscal response, or at least the fiscal spending impulse since early 2000s up to 2020. So just focusing on the last two bars there, if you would notice, since the global financial crisis, there really was no room for fiscal spending, especially in the euro area. That's why you have a tight fiscal spending in the years 2011 to 2014. Back the last 5 years also, there hasn't been much scope on that end. And even the initial estimates for 2020 didn't give much room on fiscal spending by governments. But since the crisis, you've had G3 and China really they've committed a lot of fiscal spending to combat the slowdown or the standstill in global economic activity because everybody needs to go on quarantine. So that's one of the promising markers that we're looking at. If you go to the next slide, and I think this is my last slide. Go to the next. Oh yeah, so sorry, that was my last slide. But the I guess the point that we want to, or I would like to highlight, is that markets to ultimately settle down, there needs to be three conditions to be met. The first is, clearly is visibility on the ultimate scale of the coronavirus outbreak and evidence that the infection rate has peaked over the long term. So that's number one. And we haven't seen that. Number two, we want deployment of credible and coordinated policy packages, which we are seeing now. And third, the confidence in financial markets needs to come back, or the confidence that financial markets are functioning properly needs to come back. And I think it's coming back. It is coming back. So really, we need to understand the scale and the impact of the outbreak so that policy response can set the stage for an eventual and actually even strong recovery. So that's my base case. I understand there have been views about the global recession, and again, it depends on how well this is managed. And until then, until we see signs that we're out in the the coast is clear and we're seeing all of these signals that we want to see, we remain on capital preservation mode. We have some exposure to risk, so the past couple of days move, we're not completely not exposed to that, so we're still getting some relief on these or some participation on these relief rallies. But for now, we're keeping our eyes on the long game, and this is as you saw in my first slide, such big volatility. This is a bit technical, but 2 standard deviations from usual. That's a really great opportunity to really make a lot of money in capital markets. So we want to use that to our favor. That's it.
Okay, thank you for your insights. Once again, let me remind everyone to please continue asking your questions using the Q&A button on your screens. If you would like to ask a question anonymously, you may do so by choosing that option in the Q&A section as well. We'll get to them at the end of the discussion. Let's now transition over to an update on the local Philippine market. To begin, I'll pass it over to Mr. JulianTarrobago, Jr.
Hi, good morning, everyone. I'm here to talk about the outlook and strategy for Philippine equities. So, as we all know, and as our previous speakers earlier have accurately conveyed, the COVID-19 pandemic fear has actually mutated into now concerns of a first half economic recession. Thus, this has shoved risk assets into turmoil, and the chart shows you, the first chart shows you that global equities, Asian equities, along with the PSEI, have actually fallen, ranging from 20 to 36% on a year-to-date basis. The Philippines faces a recession in the first half. I think just get that out of the way. And full year 2020 GDP growth estimates, however, continue to be all over the place. I think Philip alluded to this earlier when he spoke. The estimates ranging from, I think, negative 0.6%, while on the other hand, some economists recently came out with their numbers that still, I believe, forecast or estimate above 5% growth. So numbers are all over the place, but based on recent data, our original estimate was 4.3%, dropping, Philippine GDP going from 6% growth last year, or 5.9% last year, to around 4.3% this year. Given the recent data, or more recent data, we think that it's likely that will probably be lower, perhaps to around 3% growth appears in the cards for 2020. And then from a sectoral earnings standpoint, it's also inevitable to see sector earnings downgrades in the next few weeks or so. Next slide, please. In terms of impact on corporate earnings, our more conservative calculations, I think it doesn't hurt to be prudent nowadays in terms of estimating your top line, free cash flow, and net income numbers, and intrinsic value numbers. And it all starts from corporate earnings. In terms of the impact on corporate earnings, the slide shows our more conservative earnings calculations for 2020. And having been, with our team having been crunching the numbers over the past 2 weeks through constant channel checks with the individual corporates, especially the core positions within the core positions, our numbers suggest now more conservatively a slight contraction in growth for 2020. So if you recall, at the start of the year, we were looking at around 11% earnings growth for Philippine corporates. And this is coming off a very strong year of corporate earnings growth in 2019. If you recall, I think it was the first time in 5 to 7 years that earnings growth averaged double digit. And that was quite significant. Our view at the start of the year was that momentum would be carried over in 2020. And hence we were looking at 11%. Because of Taal and because of this, the COVID-19 pandemic, however, ultimately because of the lockdown, we are estimating earnings conservatively, overall corporate earnings, to potentially contract by about 3% in 2020. So really flattish growth for 2020, and the dispersion of the earnings growth for 2020 is on the slide. On infrastructure and industrials, we think that this includes airlines. Aviation-related names face significant reduction in air traffic. We are expecting lower trade volumes also from potential supply chain disruptions. And in terms of the infrastructure, in the infrastructure space, and maybe even in the real estate space, we anticipate construction delays in particularly large infrastructure projects. For the banks, we are already starting to anticipate economic disruption flowing from an uptick in consumer and SME NPLs or non-performing loans, and also a potential spike in credit costs, and maybe even slower loan growth for 2020. In the property space, we anticipate retail and hotel and resorts or accommodations will be most affected, while residential sales could likewise slow down and launches scale back. You could even see, it's not impossible also to see potential cancellations in terms of reservation sales. In terms of gaming, which I believe is will be the hardest hit among all the sectors, and we'll talk about that a little bit later. Our base case is still 4 to 8 weeks or 2 months of a lockdown, community quarantine, and the most relevant name in the gaming space and tourism space is obviously Bloom or Soler Casino. Our estimate is that Bloom can actually go about 4 to 5 months of suspended operations before incurring losses in 2020. In terms of the consumer discretionary space, we believe the impact is worst for consumer discretionary retailers, as they will be they're basically closed down during this period. In the mining space, base metals, in our coverage, particularly nickel and copper, or volumes sold will likely remain depressed due to low global demand for obvious reasons. There are those that will be relatively insulated and will probably minimize earnings downgrade risk. And these are consumer staples, wherein we anticipate some surge in demand, particularly in second quarter, early second quarter, due to panic buying in the second quarter. But this should normalize in the second half as consumers spending normalizes. However, that may be the benefits may be reduced or offset even by potential increases in costs due to potential supply chain disruptions. In the telco space, telecommunications, we think the impact is relatively neutral, actually maybe even mildly positive because of the increase in fixed line broadband revenues and data volume for people working from home. I mean, I'm sure those of you who are employed are very are familiarizing yourself with the new normal, at least for the next few weeks. The third telco player actually now may face some potential delays because of what's happening. And then in the power and utility space, we anticipate demand for Luzon to have declined by about 30% during the lockdown. Power generation companies with relatively higher exposure to the residential market and the wholesale electricity spot market may likewise see lower than expected power sales. So in the next slide, next slide please. The slide basically summarizes those views, our sector perspectives at this point. I want to say at this point because the numbers unfortunately are quite fluid at this point. Some corporates we're having a little bit of a challenge in terms of being able to bounce back our simulations, and but we think the numbers at this point are fairly decent and reliable. So again, this is all based on our channel checks, our intensive research done over the past couple of weeks. Our team of analysts constantly crunching the numbers, looking out for potential disaster areas, and so far, I guess the view there is there will be significant downgrade. There is significant early downgrade risk, but at this point the numbers show that the impact so far is hardly catastrophic. I would say. I mean, at least on a full year basis. I mean, anticipate really negative earnings disclosures probably for the first quarter and second quarter, but we anticipate things to bounce back after that. Okay, so earnings will probably, GDP will probably grow below 4%. To summarize, and then earnings this year will probably contract to about negative 3%. However, the panic selling in the market currently, we've seen indiscriminate selling, we've seen panic selling, has actually hammered valuations. Based on our adjusted numbers, valuations have been hammered down to 2009 crisis levels. And that's significant because 2008, 2009 was the worst financial crisis in financial market history. The price earnings ratio then showed that we are at those levels. However, I just wanted to note that the simple calculation of the price earnings ratio is, while simple and important and meaningful in terms of determining valuations, it has some deficiencies. It doesn't account for non-recurring items, earnings dilution, and during periods like this, we revert to the Warren Buffett ratio, or the market cap to GDP. And the next slide shows that market cap to GDP has actually dropped below 60%. And that is significant because the last time it dropped below 60% was during the worst financial crisis in history. In the next slide, just adding some perspective, 2009 during the crisis and today, there have been considerable improvements. The S&P credit rating is now BBB positive from BB negative in 2009. Note that the S&P credit rating now is merely one notch below S&P A credit rating. Next is GDP per capita, which has increased to almost $8,000 from $5,300 back in 2009. Government to GDP has likewise improved to about 42% compared to 55% in 2009. The unemployment rate has moved closer to full employment, 5.3% from 7.5% in 2009. And lastly, the gross international reserves of the Philippines has actually doubled since 2009 to about $88 billion. So I would think significant improvements in today compared to where we were from a macroeconomic standpoint in 2009. And then corporate buybacks actually resuming in the Philippines right now. So the next slide shows corporate buybacks. So these are the companies realizing there is significant value in their shares and putting their money where their mouth is. Next slide is basically our outlook. And would like to stress that, well, me personally, having been in the market for 25 years already, there are certain lessons from past crises, and we draw upon those. The lessons is that every crisis is different, but there are commonalities, like how the market phases pan out. Now we're seeing indiscriminate selling, which is usually indicative of panic and panic selling. So once you've established that, we are looking for peak panic. Usually, at least from lessons over the past 25 years, after you see peak panic is followed by periods of stability wherein sentiment eases. And following that, we usually see a sharp market recovery, at least if history is to repeat itself, and I think personally it will. Yeah, this argument holds unless you think the economy is broken, and our view is that the economy is not broken. Our view is that we may need to brace for a first half recession in the Philippines, but after which the economy will likely rebound in the second half of 2020. Whether it's third quarter, fourth quarter, it's likely to rebound in the second half of 2020. That said, we think the volatility in the market will continue, and we may see peak panic, most likely within the next 4 to 8 weeks. And how do we define, what are the conditions for peak panic? I think Sandra alluded to this a bit earlier. So first is COVID-19 daily infection rates peak. Second is when global manufacturing indices, or the PMIs, hit troughs or have bottomed out. The third is if we have clear-cut fiscal easing become more evident. And we've actually seen that a bit in the US. I think it was $2 trillion stimulus. And as Phil mentioned, there was a 75 in the Philippines. There was on the monetary side, we had a 75 basis point policy cut. We had a 200 basis point RRR, or reserve requirement cut. And the approved cuts for this year is another 200 to go to 400 basis points cut in 2020. And we had a 300 billion peso or $6 billion budget for government security purchases and additional relief for the banks. On the fiscal side, we had 27 billion pesos spending package. That's about $500 billion. Although, I mean, could have been larger. It's just 0.1% of GDP. Special powers like granted, which include aligning the budget for what's needed. So there, we think a rebound is likely in the second half on the back of domestic demand economy, continuation of monetary policy, accommodative policy, and the resumption of the massive government infrastructure spending program. Outside of that, we note structural improvements should be in the markets arising from one, potential large cut in the corporate income tax rate. There are indications that the corporate income tax rate may actually be cut by about 500 basis points. And then Also, the recent lifting of foreign ownership limits in most of the sectors in the economy. And then lastly, the the real estate investment trust law, wherein we have Ayala Land coming out with the first REIT, I think on June 6. And we think the REIT law will actually revolutionize the property or the real estate industry. So those are things to be positive about. I mentioned earlier, we are at crisis valuations. If we just go back to where we were at the start of the year, you're already talking about almost 50% upside at current levels. Our strategy is to improve positions in cheap, best-of-breed index stocks, and the funding will be via continued reduction of non-index equities and blue chips that have the propensity to slow down even after this crisis. So the last slide is on strategy. So we are positioning for 2021. We're not trying to be a hero here. We're not jumping in indiscriminately buying. We are timing our buying during the periods of big dips, and we are very selectively buying, focusing on just a few names of high quality and suddenly cheap blue chips. In January, we employed the strategy of reducing non-index names with greater value emerging significantly in the index names and reallocating these proceeds into best-of-breed blue chips such as SM, Ayala Corp, SM Prime, Jollibee, BPI, among others. I never thought we could buy these companies at current levels. BPI, for example, at 0.8, 0.7 times book value. These high quality stocks are at fire sale prices. The slide shows you potential upside on each name. Of course, here we also have a mix of second liners, small and mid cap companies, but the focus is really now on buying the large caps where we see considerable value. We're not buying blue chips blindly. We are focused on buying blue chips with strong balance sheets. I was in a call with Ayala Corp just yesterday, and our understanding, if our calculations are correct, they have about 47 billion pesos in dry powder, about 20 billion in cash, and the balance in credit lines. So in case of more problems ahead, so that's one, strong balance sheets. The second is the ability to bounce back strong or even stronger after this crisis, and the third is ESG related. Companies that don't trade lives for profits or earnings. So we're closely monitoring how the companies are now treating sick or displaced employees. To reduce cash, we are maintaining cash levels at about 10% at this point. So yeah, that's it for me. I think we'll be happy to take your questions if any.
Okay, thank you, June. And thank you once again to all our speakers. What we're going to do now is open up the floor to a few questions from the audience. I think we have one here for Sandra. So do you have any thoughts on the technology sector? Is it a sector that would benefit greatly from COVID-19 disruption?
Okay, thank you. That's a great question. Actually, I was just talking to a friend of mine who works for Amazon Web Services, and he was telling me how, working from home, we've all never been busier, and from his purview, it's really the cloud service and all of these technological advances enabling us to continue working despite the very restrictive reality that we are facing, and that's actually for me indicative or supports the strategic view of holding or being exposed to these tech companies as far as a long-term investment is concerned. Now, it doesn't mean to say that it's going to be a smooth ride. Not at all, because these tend to be high beta stocks, and high growth and earnings expectations are typically priced in, and technology is also, because of the nature of it, it's new. It's not a straightforward way to value these companies. You really need expertise in that regard. So yes, tech is going to be a winner out of this, I think, but it's equally important to be able to choose the right companies to have exposure on, because it's such a broad field. There's hardware, software, cloud, everything, right? So that's why we have, when we choose our funds, we make sure that these managers really understand the space and they have a good narrative and they're choosing well within the industry. And I'm pretty confident that our tech fund is doing just that, and that's exactly why we chose it.
Okay, great. Thank you, Sandra. I think we have time, unfortunately, for only one more question. However, we appreciate all the questions that came in. We'll make sure to answer them in our next call. So this is for June. It's a very simple one. If a client has extra funds lying around, would you advise getting into the market at this point?
Yes, I would advise them getting into the market at this point in tranches still, because I don't think we've seen peak panic. But our view is also that the economy is not broken, and that we anticipate GDP and earnings growth to rebound in the second half of the year. And there is a lot of opportunity to make meaningful returns, long-term returns, as high quality names, good stocks, good companies have been beaten to a pulp and present meaningful, high quality upside.
Okay, great. I think we can leave it there for this call. Thank you to all our speakers and to our audience as well for all the questions. Again, we'll answer them in our next call. We appreciate you taking the time to join us. And on behalf of ATRAM, I would like to wish you all the best of luck. Please stay safe. Thank you very much and have a great afternoon.